go. So add. All right. Um, well, hello again. So I'm going to continue what I was talking about a little bit earlier today in the previous video, just to expound upon what I was talking about, in that FUD is one of the great killers of many traders' positions and trading accounts. So right now, there's a lot of FUD going around. People are nervous, and I've been saying to you for weeks that they're going to get nervous here. I've been saying that the big buyers, the banks, the people who hold the largest positions with ETFs, who've accumulated more than 1 million Bitcoin in the last 5 months, they love this time because they know they can shake out a lot of Bitcoin and other assets from the weak hands. And those big banks and financial institutions, what do they want to do? They want to get as much control over as much of this crypto as they possibly can in as short of a period of time as they can, while they consider the prices to be relatively cheap, because for them 70K for a Bitcoin is cheap relatively. It's cheap because yes, of course it was cheaper when it was 50K, right? 30K, 20K, 10K, 5K, $1. But when it was those prices, they considered it to be a riskier asset. Now you think to yourself, well, that's silly. If they bought it when it was $1 or $10 or $100, they could own the whole freaking market. Well, yes, in theory. But then if they owned the entire freaking market at that point and at that price, there might not be an interested retail market. So they had to wait to see that there would actually be retail liquidity willing to enter the space. And once they saw that that was the case, then they began plugging away, seeking ways to capitalize on that. And ETFs were an obvious choice for them to do that. And it took them a good 9 years. Once they got around to having the big boys tell the SEC, hey, we see ways to make money on this, that the government can take a nice chunk of revenue from through usual taxation and everything by issuing ETFs, which are SEC regulated and therefore taxed properly and all that kind of stuff. Then the SEC's ears perked up and said, okay, if you guys are going to do this, I'm going to give you the permission. Well, that's exactly what happened. And so that's why once the BTC ETFs were launched, we saw a massive inflow of capital into those ETFs. A lot of it from retail, of course, but most of it so far from the actual issuers and other large financial institutions buying each other's ETFs or buying their own in many cases, and basically investing in their own future by holding not just the spot, right, the underlying asset, but actually also buying their own ETFs, which may seem strange to people. Like, wait, why would they buy the spot and the ETFs? Well, they do that for a number of reasons. One is to own a good chunk of the market. 2 is to provide liquidity to the market. Right? 3 is to drive interest in the market. If retail traders or retail investors here, there's already 1 million Bitcoins have been bought in just 5 months, and they don't necessarily know all the details, they might be more interested in buying some ETFs rather than the underlying, especially when we're talking about people in general who prefer buying ETFs to actually owning underlying assets, right? The whole purpose of an ETF is to have it be custodied by somebody else that you trust, or some big financial firm, etc. And it gives you a measure of quote-unquote safety and stability, etc., because it's backed by assets, and it's regulated by the government, so it gives people a measure of confidence that they might not have if they have to learn how to self-custody and all these other kind of things. Well, that leads us to where we are today. We've now seen 3 months of sideways action since the all-time highs on Bitcoin, for example. Well, what exactly does that mean? As I explained previously, it's really just, a demonstration of more buy pressure and sell pressure, and buy pressure and sell pressure, right? There really are, as I say many times, there are no bull markets and there are no bear markets. There is just buy pressure and sell pressure, and it happens on low time frames, and those low time frames form what we see on higher time frames. So yeah, you can trade higher time frames, and all that is an amalgam, an aggregate, if you will, of what's happening on the lower time frames. Which is why, if you're actually a real day trader, or intraday trader, or scalper, or whatever you want to call yourself, right, then you are typically trading multiple trades in the same day. Why? Well, the answer to why is because there are statistically, simply, more occurrences of opportunity when you are trading low time frames than there are on higher time frames. And this kind of should be obvious to anyone who has eyes, or an eye, or an ability to read a chart. Maybe you read it in Braille, I don't know. But the point is, the lower the time frames you are trading, the more occurrences of opportunity there are, as long as you have the right speed, position, and info. Because those are the three things that you have somewhat of an ability to control. Speed, of course, you're limited by things like your computer speed, your network speed, your speed connecting to the markets, right? That's your speed and your ability to, click buy and sell, and fill out positions, right? That's your speed issues. And you have some control over that, but not full control, especially if you're not operating within an HFT firm or some other company that has huge capital resources that they can spend on having the fastest possible speed to the networks and to the markets that they trade on. Right? They warehouse their servers all around the world near the capital markets, and usually they'll put them in the same warehouse where the servers of the actual exchanges are housed, so that they're literally just a few computer racks away from the actual exchange racks, exchange servers. So that gives them the ultimate speed, right? And the position, well, the position is your position in the order book. What is your position? Are you the first order? Are you the last order? Are you somewhere in between? And that is largely determined by your position size. So if you have a tiny position, you're going to be closer to the last orders, meaning yours will be the last ones to get filled. If you have a very large position, or the largest position, you'll be at the front of the line. And that is who gets served first. Now, it doesn't mean that your tiny position won't get filled. But of course, if you run market orders, your position will get filled immediately. And for that gratification, for that premium ability, you pay a premium price. Which is why, people who take market orders are called market takers, because you're taking whatever the market's giving to you, and that means you're paying a premium price to do so. And that gives you the ability to get your orders filled immediately. But of course, that means that every position you open is at somewhat of a loss, because unless you're trading on an exchange that has no fees, even for market takers, right, for instant orders, then and most exchanges don't give you that. Most exchanges will take anywhere from 0.5 to 2% on your market taker orders, right? So if you're running market taker orders, then that means that you're starting your positions at a loss, and you have to hope that the asset goes your way. Much more than if you're running a limit order, where many exchanges will let you, start those positions or enter those positions with no fee or very minimal fee, like 0.1% or 0.2%, maybe as much as 0.5%, but usually not. Especially in crypto, where they're trying to get people to onboard and trade as much as possible. So they tend to lower those fees for market makers, right, who are running limit orders. And what is a market maker? It's somebody who provides liquidity to the market. So that's why you're called a market maker. You're making the markets. Just like the big HFT firms that are running those huge positions, millions of orders per second, using extremely sophisticated bots. They're providing liquidity, and they're also not even paying the same fees that you pay as a retail trader. They have completely different fees, and they pay for other things like, access to order book data that you just simply don't have access to as a retail trader. So again, there are no bull markets. This is not the end of the bull market. This is not the beginning of a bear market. This is not this is not a sideways market. The market is the market. Yeah, sure, you can say, well, the aggregate of this market went up more in March than it did in last August. Okay, that doesn't mean it's a bull market or a bear market. That just means that in March or in February there was more buy pressure than last August. That's all it means, right? So keep that in mind. Don't get duped and tricked into thinking that there are bull markets and bear markets. Those are just convenient terms to sell headlines and the things that they advertise around them. All right, that's it for now. Happy trading.